All right. Gabriel Zucman, welcome to the podcast. Thanks for joining us.
Thanks for having me.
Could we maybe start by you saying just a few words about yourself?
I'm Gabriel Zucman. I'm a professor of economics. I'm the director of the EU Tax Observatory, which we are currently transforming into a global tax observatory.
Oh, you heard it there first.
Yes. And I conduct research on taxation and inequality.
Perfect. So we brought you here today, and we're very happy to have you because we're talking about this modest proposal for a globally coordinated tax on billionaires or on extreme wealth. But before we get into the details of that, I thought we would just ask, what is the central issue when it comes to taxing people at the top of the income or wealth distribution today? And why should we care?
Perhaps the biggest issue that we have with our tax systems today is that they fail to tax the super rich. And for a long time, it was difficult to quantify the size of the problem because public statistics are highly deficient when it comes to the super rich. Usually you don't have good data about their wealth, good public data about their wealth, the taxes that they pay. But over the last 5-6 years, you've had a number of research papers and research projects in collaboration with tax administrations in different countries that have shed light on this issue, whether it's in France, in the Netherlands, in the US, and there's ongoing work in Norway, in Sweden, and so on. And now a very clear picture emerges, which is that when you take into account all taxes at all levels of government, the super rich, let's say people with more than $100 million in wealth, have much lower total effective tax rates than the middle class or the working class. So that's the key issue. It's an issue of fairness, of course. It's also an issue that's quantitatively large in terms of tax revenue, because these individuals are very, very rich. So they could pay a lot of tax, but they don't, which means that the rest of the population has to pay more.
Right. A point you make in your paper is that especially there's a problem with the income tax for the wealthiest. Could you explain how the income tax fails to capture the richest?
The income tax, in principle, is supposed to be the pillar of tax progressivity. The income tax is a tremendous innovation, a tremendous creation, but it's a relatively old creation. The progressive income tax was created in most countries, in the early 20th century or late 19th century. And at the time, it was really a revolution, but that revolution is still incomplete. Even a century after its beginning, it's incomplete because the income tax still fails to tax the super rich. The fundamental problem is that when you're extremely wealthy, it is easy to structure your wealth such that this wealth will generate no or very little taxable income. And so that's how you end up in situations like people like Jeff Bezos, like Elon Musk, can report zero or almost zero taxable income. We know that from the ProPublica revelations in the US a few years ago. But what we've learned with the research that's been conducted recently is that the problem is much more general than that. It's not just a few US billionaires, it's a problem also in Norway, it's a problem everywhere, that past a certain level of wealth, it's just systematic and very easy to report very little taxable income.
And you explain two sort of main broad mechanisms for how they sort of avoid the income tax or reporting their income. Can you explain those two methods?
Well, the first one is, first it's important to remember that the key source of wealth for the super rich is owning businesses. They own companies. And so their income is the profits that these companies make, and they can avoid paying tax on those profits first by instructing the companies that they control to not distribute any dividend. And they can also avoid realizing capital gains. In many countries, you have a tax on capital gains, but if you never sell shares, then you don't pay capital gains taxes. So that's one way. The other way is sometimes, the super rich, they own shares in companies that are listed on the stock market. They can't fully control the dividend distribution policy, or they want, for whatever reason, the company to pay out dividends to various shareholders. But they can still avoid the dividend tax by using a holding company. So essentially, they transfer the ownership of their shares to a personal holding company. The holding company then earns dividends free from the individual income tax. And as long as that income is saved by the holding and reinvested, no income tax is earned by the actual owners of these holdings.
And there are some anti-abuse rules in place in the US to stop these holding companies from being as abused, as you might say, which are not in place in Europe, which leads to that it's still very regressive at the top in the US, but it's a bit less regressive. Could you explain
That's really interesting. Yes, it's a fascinating story because the US income tax, the federal income tax, was created in 1913. And very quickly, the tax administration and the US Treasury realized that a number of very wealthy Americans were using holding companies to avoid the individual income tax. And so in the 1920s and 1930s, the US passed 2 laws to prevent that tax avoidance, essentially putting a huge penalty for people using holding companies for the purpose of avoiding the individual income tax. And so since the 1930s, essentially it's been impossible in the US to use that second tax avoidance technique. So let me take a very simple example. For instance, Bill Gates owns shares in Microsoft. Microsoft distributes dividends. If Bill Gates was living in Norway or in France, it would be very easy for him to avoid paying taxes on those Microsoft dividends. He would create a holding company, the holding company would receive the dividends, and that would be tax-free. In the US, it's impossible. The dividends that he receives through his holding company are considered to be directly paid to him. The holding is seen as is transparent from a tax perspective, and so the full amount of all the dividends he receives is automatically included in his own personal income and subject to the individual income tax. That's why you have some billionaires in the US that do end up paying some taxes, not zero. You also have many others like Bezos or Musk that pay zero because the companies that they own, in contrast to Microsoft, Amazon, for instance, doesn't distribute dividends. And so, in that case, it's just very easy to pay nothing.
We'll move to the wealth tax discussion in just a bit. But one final point on the income tax is that we just saw you debate, among others, a member of parliament from the Conservative Party in Norway. And you had a bit of a disagreement on the definition of income. I think that essentially what you said is that for rich people, income tax is actually a consumption tax, while the member of the Conservative Party said that money has to be realized before it can be considered income. Could you explain how you define income and how you disagree on this moment?
Everybody agrees, at least all economists agree, that income is the sum of consumption and saving. To get some income, you can do 2 things. Either you consume it. If you don't consume it, you save it. For the super rich, the fraction of your income that you can consume is not very large. If you earn hundreds of millions in income, at some point, it's difficult to consume such large amounts. And so saving rates tend to be very high, up to almost 100% for the super rich. But what the super rich do is that they save income through companies. Okay, they earn income through companies, and the money remains in their holding companies, is saved in the holding companies, because what else can they do with it? They've already consumed a lot. It remains in the holding, it is saved in the holding company, and it is reinvested. All of that saving, which accounts for the vast majority of their income, is tax-free. While for regular people, for workers, if you want to save, you first have to pay the income tax. If your income is wage, you pay tax on your wage income, and whatever remains after you've paid your taxes, you can consume or you can save, but you can only save after having paid the income tax. So that's the problem. That's the fundamental failure of the income tax today in Norway, but in almost all other countries, which is that the income tax is a tax on comprehensive income, consumption plus saving for the vast majority of people. But for the super rich, the income tax is just a tax on consumption. They only pay the income tax to the extent that they withdraw income from their holding company to then consume. But that corresponds to only a tiny fraction of their income.
And it's a point that you can still sort of use the money as, for instance, collateral to take up loans, for instance, when it's not realized. And you mentioned that Elon Musk, because of the argument is that the money is not liquid. But as you said in the panel discussion, Elon Musk did not have any liquid income, but suddenly he could still buy Twitter, right?
Yeah, exactly. I mean, this is a widespread misconception that people have, this idea that if the income remains in companies and saved in companies, then it doesn't really exist. It's a fiction. It's trapped, and it's not really income for the owners of the companies, and so it shouldn't be taxed. That view is really completely wrong. It's not. This income is not trapped in any meaningful sense. This income is saved in the companies. It's just that it's saved tax-free, and it is reinvested, and so it adds up to the wealth of these individuals. And wealth is not some fiction, something that exists only on paper. I know people who dislike wealth taxation, at the end of the day, one of their main arguments is always, but wealth, does it really exist? It's some kind of, paper gains. That's all a big fiction. Well, except that, no, it does exist, because then when you want to use your wealth, for instance, to buy Twitter, like Musk did, he had no taxable income on his individual income tax return, but when he needed more than 40 billion to buy Twitter, he could get it. He could go to the bank and say, look, I'm very rich. I have all these shares in Tesla. Doesn't distribute dividends, so there's no taxable income, but, it's highly valuable. He put his shares as collateral. He got loans, and he could buy Twitter. And don't tell me this is not real. Don't tell me this doesn't have real effects. We all know it has real effects, and, not minor effects, pretty big effects on U.S. democracy, and now increasingly on politics globally. Wealth is real.
Yeah, for sure. And I think that's why also, you mentioned it as well, but just a couple of weeks ago, we saw a couple of days ago, we saw the president of the United States being inaugurated with some of the richest men in the world in the room. So in this context, I think your proposal for a minimum tax on wealth is even more, prevalent. Do you want to just kind of explain the basics of how your proposal can tackle some of these issues that we've now outlined?
Yeah, I think indeed, the taxing billionaires is more needed than ever. And for some time, some people made the argument that extreme wealth is irrelevant, that there cannot be such a thing as too much wealth. Too much wealth concentration can never be an issue. Whether someone has 100 billion, 1 trillion, 10 trillion, who cares? What matters is what regular people have. And, these are two completely disconnected things. I think now this type of argument is very hard to make when you see the very in your face, plutocratic capture of U.S. institutions by U.S. billionaires. It's just very hard to make that type of argument today. This type of argument was always, not very strong because it's been understood for centuries, for millennia. In fact, it's already, in some of the Greek philosophers, Aristotle talks about that, but many others over the centuries have, explained what is obvious to most people, which is that there is a tension between extreme wealth and an extreme concentration of wealth and democracy. That wealth for the very rich is power. It's the power to influence policies. It's the power to influence democratic institutions, policymakers, and so that there is this inherent tension. So it's important to make sure that wealth concentration is kept in check. How do we do that? We can do that with taxes, and taxes are very powerful tool. In fact, probably the most powerful tool to regulate inequality, whether it's income or wealth inequality. But I want to stress that the proposal that I make of having a minimum tax of 2% on wealth is extremely modest and is not going to solve, I want to be very clear about that, problems of wealth inequality and plutocratic capture. Because the wealth of billionaires globally has been growing at more than 7% a year on average since the 1980s. If you tax it at 2%, everything else equal, it would grow 5% a year, which would still be much more than the average rate of growth for wealth for the average person, which is more like 3%. So with a minimum tax of 2% on wealth, I want to be very clear about that it wouldn't reduce wealth concentration. It wouldn't even stabilize wealth concentration. It would just slow down a little bit the pace of the increase in wealth concentration. So it's not going to be enough to address the very serious issues that you alluded to. That being said, we have to start somewhere. And today, billionaires pay zero, and moving from zero to something positive, even if it's only 2%, will already be a big progress. And why 2%? With 2%, you can erase essentially the regressivity of our tax systems. With 2%, the tax system wouldn't be progressive, meaning billionaires wouldn't pay more tax than working class people, but they wouldn't pay less, which is important because I think it's a standard. It's a norm that everybody can agree to. That's why it makes sense to have a proposal like that at the international level, because it's realistic to envision a world where we all agree that billionaires shouldn't pay less than their secretaries, and so we can agree on 2%. And then within each country, there's a proper debate, a very legitimate debate about how progressive the tax system should be. And so some countries might want to go beyond, perhaps way beyond 2%, depending on the specificities of their society, how much inequality there is, and so on. But having this international floor where the rate cannot go below 2% would strengthen the ability of countries to implement their own progressive policies on top of that. So it would complement domestic action and not substitute for domestic progressive policies.
Yeah. And I think that argument for, kind of a popular support for this type of action, especially when it's so targeted to those very few, what is it, like $3,000 billionaires globally, I think it's very powerful. But I also want to focus on the more technical feasibility beyond the political. You highlight in your report that you made to the G20 that there are certain factors right now that are quite new developments, which make this an even more, feasible proposal. Do you want to just kind of focus a bit on that?
Yes. I think this type of international agreement on minimum tax for the super rich has become technically feasible thanks to some important progress that has happened over the last 10 years in international economic cooperation. Now, two developments that are particularly important. One is the automatic exchange of bank information. So since 2017, more than 100 countries, including all the key tax havens, automatically share bank account information with foreign tax authorities. It's really a groundbreaking development, I'm not saying it has solved all the problems of offshore tax evasion. No, for sure not. But it's a move from complete bank secrecy to a standard of transparency, which means that now tax authorities are in a much stronger position to limit tax evasion, offshore tax evasion, the concealment of wealth in tax havens than 10 years ago. So that's great. We should use that. The problem is that we're not really using it. This great advance, which is the automatic exchange of bank information. Tax authorities receive a lot of data, but they are not doing a lot with that, and policies has not really evolved and realized the potential that this opens for improving our tax systems. That's one thing. The second thing is the agreement on a minimum tax on multinational companies. So in 2021, 130 countries agreed on a 15% minimum tax, what is known as the Pillar 2 of the OECD two-pillar process. And look, this minimum tax is very weak in many ways. 15% is a very low rate. You have all sorts of exemptions, but it has two key virtues. Number one, it demonstrates very clearly that just like we can choose competition, we can also choose coordination. And that tax competition is not some kind of law of nature. Okay, we can come to an agreement. Okay, good. That was the first time ever that there was an agreement on a common minimum tax rate. Second, and perhaps even more important, this agreement has a set of interesting provisions that essentially say that if some countries refuse to implement the minimum tax, the other countries, those that implement the agreement, will be allowed to overtax the multinationals of non-participating countries so that they too face a 15% minimum tax rate. So let's call it as it is. It's an extraterritorial provision, but it's a good one. It's a very important one. And it's essential, in fact, because it provides incentives for all countries to join the agreement. Not joining is irrational. It means leaving money on the table for other countries to grab. And second, it ensures that even if some countries, for whatever reason, refuse to join, it's not a problem. Their multinationals will also be taxed. So there will be a level playing field. There will not be a risk that multinationals will move to those tax havens. That's really essential because it shows that not only can we have international agreements on tax rates, but we don't need the participation of all countries. It's enough to have just a coalition of the willing doing that and saying, not only we are going to tax our multinationals or tomorrow our billionaires, but we will also tax those of other countries if they don't do it themselves. And importantly, the US has not ratified the 15% minimum tax. And so what countries are going to do is that they are going to start overtaxing US multinationals to make sure that they also face this 50% rate. And of course, now the Trump administration hates it, right?
Yeah.
And they're going to fight.
Yeah.
But it's a good fight.
Yeah.
And European countries and all the countries, and it goes way beyond Europe, that implement those kind of safeguard clauses, these clauses of tax collector of last resort, they have to stand firm. They have to apply those rules. It's essential. And it's a logic that not only must be defended, but that must be extended. You can apply it to multinationals, you can apply it to billionaires, you can apply it to carbon. If you are not taxed, if a country fails to implement a minimum standard, and we're talking about minimums, 15% for multinationals, 2% for billionaires, these are not high rates. These are the minimum standards we need to prevent an explosion of inequality. Or we need also minimum standards for carbon taxation to prevent catastrophic climate change. Yeah. If you refuse to do that, the other countries will force you to do that. We need that, for the sustainability of our planet.
Yeah.
So you've sort of mentioned a lot of them already, but I'm wondering, what do you think the main challenges are going forward? You've mentioned the Trump administration. You've mentioned this element of imperfect coordination and how we might solve that between countries. Also, you mentioned the automatic exchange of information, bank secrecy, financial opacity, and also maybe sort of how you actually measure wealth. What do you think are the sort of biggest problems facing this idea and moving forward?
The biggest problem, to be fair, is something you didn't mention, is that the wealthy are going to fight tooth and nail against this. And you don't want to underestimate the influence and the power that they have. And they are going to fight because they have good reason to hate this tax. They hate it, and they hate it for a good reason. It's because this is the one tax that will actually make a difference to how much they would pay. And so it's going, the big challenge, to be frank, is not a technical challenge. It's not about measuring wealth. We know how to measure wealth for these people. It's not about international coordination because we understand how even with imperfect coordination you can make it work. The main challenge is how do the forces of democracy prevail over the forces of oligarchy? And it's a fight that I think, there are very good reasons to be optimistic about democracy prevailing, but it's going to be really important for civil society to mobilize, for political parties, for voters, for citizens, for researchers, for everybody to be in that fight, because you can be sure that the oligarchs, they are going to fight for their money. And so if we don't fight for democracy, we're going to lose. That's the main challenge.
Yeah.
Well, thank you so much, Gabriel. It's really, really great that you came here to Norway to talk about this. I think a great thing about your idea is how it connects so many things that the tax justice movement has been working on for so long. Automatic exchange of information, country-by-country reporting, beneficial ownership information. You need all this stuff to be able to actually tax the billionaires, as you suggest. So we'll keep on fighting here in Norway for these measures, and hopefully your idea can become a reality. But thank you so much.
Thank you so much.